You know exactly what I'm talking about. You're scrolling TikTok or Insta, and every other video is some guru pitching passive income through real estate. And if you've got serious entrepreneurial ambitions, maybe you've looked at a hotel, done some quick math on room prices and occupancy, and thought, now that is a business worth getting into. And honestly, you aren't wrong. Hotels can be incredibly profitable. But in this explainer, we're going to look at why the reality of hotel ownership is far, far more complex than the dream. Because that massive hotel you think you're buying, it isn't exactly yours.
To really understand how this all works, we first have to grasp the sheer scale of the board we're playing on here. There are roughly 700,000 hotels in the world today. Combined, they're generating over $1.5 trillion in revenue every single year. It is a massive, globally entrenched industry. But the crazy part? The people who actually put up the money, build the buildings, and hire the staff, they keep way less of that massive pie than you'd expect.
Okay, let's dive into this, because here is the statistic that completely breaks people's brains. Hilton actually owns just 3% of its 9,000 properties worldwide. Marriott doesn't own most Marriott hotels. Those giant, iconic names on the buildings that dominate your city's skyline, yeah, they don't actually own the real estate underneath those massive neon signs.
Section 1. The Hotel Ownership Illusion.
So if the big brands don't own them, who actually does? Well, they belong to private investors, real estate funds, and independent developers. These are the people who paid billions of their own money to build or buy the properties, and then literally handed the keys over to a massive brand just to put their famous name on the sign. And let me tell you, getting into this game is the furthest thing from passive. It requires an unbelievable amount of upfront capital. Let's say you want to build a standard 100-room Hampton Inn in a mid-sized U.S. city. Just to get the land, the construction, the furniture, and that initial $100,000 franchise fee sorted, you are looking at dropping $15 to $22 million. Don't want to build from scratch? No problem. But buying an existing 250-room hotel near a major airport in 2024 was trading at roughly $241,000 per room. That is $60 million on the table before you have even changed a single light bulb.
Section 2. Death by hidden fees.
That massive barrier to entry, yeah, that's just the warm-up. Once you actually own the building, the real squeeze begins. The operational grind of running a branded hotel is absolutely brutal. It's driven by a whole system of mandatory costs and hidden fees that systematically devour your cash flow before you see a single dollar of profit. Because the moment you take ownership, the clock starts ticking. The brand will immediately hand you a document called a PIP, or Property Improvement Plan. This is a mandatory list of renovations you have to complete to bring the building up to their current standards. Think of it like a forced iOS update, but instead of taking 10 minutes, it drains $5 to $10 million from your bank account. We're talking new carpets, totally new lobby designs, maybe entirely new HVAC systems. And you absolutely cannot say no. If you refuse, they just take their brand name off your building. And as the saying goes in this industry, a hotel without a brand is just a building with beds.
And this brilliantly illustrates just how fast your money vanishes once the doors actually open. Look at how quickly your revenue pie disappears. The brand takes their cut first, of course. Royalties and marketing fees eat up about 10%. Then, because most owners hire a management company to actually run the day-to-day, well, that's another 3 to 5%. Then you've got the online travel agencies, the OTAs, like Booking.com and Expedia. Their commissions have quietly climbed and can now eat up 15 to 30% of a booking. Add in labor at 34%, and suddenly the owner's net profit margin is squeezed down to a measly 8 to 10%.
And that daily grind, it is only getting harder. Just look at the numbers from 2024. Labor costs went up 4.8%. Insurance costs absolutely skyrocketed by 17% in a single year. Plus all those mandatory fees we talked about, like a 6% royalty to Marriott, plus your management fees. When you stack all of this up, an owner of a hotel bringing in $5 million in revenue might only see $400,000 to $500,000 in actual profit. Best case scenario, you are looking at a 30-year payback period just to earn back your initial $15 million investment.
Section 3. The Asset Light Masterclass.
Now, if you really want to understand how modern wealth and scale actually work, you need to look at the big brands. The contrast here is just staggering. The hotel owner is grinding every single day for an 8 to 10% margin, dealing with staffing headaches, fighting OTAs, and paying for every single physical repair. The brand, however, they operate on what's called an asset-light model. It's basically the ultimate SaaS platform, software as a service, or a real-world subscription business. They collect a percentage of every dollar your franchised hotel earns, completely regardless of whether your hotel is actually profitable. If you have a terrible quarter, Marriott gets paid. If a recession hits, Marriott gets paid. If the roof literally caves in, well, that's your problem to fix. But Marriott still gets paid.
The sheer volume of cash this model generates is insane. In 2025, Marriott reported an incredible $5.4 billion in gross fee revenues. Notice I didn't say hotel revenue. That is fee revenue. This is pure, risk-free cash collected from property owners just for the privilege of using the Marriott system, the Marriott name, and the Marriott Standards Manual. They are achieving massive profit margins without actually owning the underlying real estate.
Section 4. How to actually win.
So how do real entrepreneurs actually bootstrap and win in such a brutal industry? Because make no mistake, people do make real generational money owning hotels. The answer lies in one of the most incredible entrepreneurial success stories in modern history. The American hotel industry has been quietly dominated for decades by a single immigrant community, Gujarati Indians, often associated with the Patel archetype. As of recent estimates, Americans of Indian origin own roughly 60% of all economy and mid-scale hotels in the United States. That is a combined value of over $700 billion in hotel assets.
Let's move to and see how this builds, because this community essentially invented the ultimate house hacking scaling playbook, but for commercial real estate. Here's how they do it. Step 1. Arrive and buy a small independent motel. Step 2. Live on site and run it entirely as a family operation. This drastically reduces outside labor and completely eliminates those expensive management company fees. Step 3. Reinvest everything, buy a second property, and franchise it under a brand name solely to get access to their massive reservation systems. Step 4. Scale and repeat. They're using the brand as a distribution tool, not a dependency.
This model proves that the secret to the hotel industry isn't buying one expensive property and just praying your 8% margins hold up. It's all about vertical integration. It's about distributing those heavy operational costs across multiple properties. As the fundamental truth of the industry goes, one hotel is a job, 10 hotels is a business. This industry aggressively rewards patience, tight cost control, and compounding scale.
Because honestly, if you stay small, the math will crush you. Let's summarize the exact reality for a single property owner. You drop your $15 million investment. You generate a very healthy-sounding $3.5 to $4 million in annual revenue. But after the brand fees, the management, the labor, the insurance, and paying the debt service on your loan, your actual free cash flow shrinks down to just $200,000 to $400,000 a year. On a $15 million investment, that is a remarkably tiny return, roughly 1.3 to 2.6%. It is absolutely razor thin.
So the crucial point is, just when you think you finally stabilized that profit, you hit the PIP trap. By year 7 to 10, the brand comes knocking again and demands another mandatory property improvement plan. Budget another $2 to $5 million. You are effectively trapped in a cycle of constant, non-stop renovation. And if you think, okay, I'll just sell it, well, the next buyer knows they have to pay for that upcoming PIP, which instantly suppresses the resale value of your property.
Meanwhile, the brand's stock is up, their pipeline of new hotels is huge, and your expensive renovations are entirely your problem. Because the big brands figured something out decades ago. The real money isn't in physical real estate. They aren't real estate companies. They're tech and loyalty platforms. Marriott's true assets are totally intangible. It's the Marriott Bonvoy program with its 237 million members. It's Hilton Honors with 215 million members. It's the reservation technology and that slick app on your phone. They own the intellectual property that drives the entire industry's revenue.
Which leaves us with a massive rethink of how modern wealth is actually built. The next time you walk into a beautifully renovated, brilliantly branded hotel, don't just look at the luxurious lobby or the expensive fixtures. Look at the invisible economics at play. Because the most valuable thing in that entire building isn't the real estate at all. It's the name on the door. And as an entrepreneur, you have to ask yourself, in today's economy, are you investing in the heavy, expensive building?